Hello folks, Professor Watts here, and we are now kicking off Unit 6, which is our final unit in macro, Principles Macro. And this is fiscal policy. So fiscal policy refers to actions of government finance or the state treasury. So we're talking about taxing, policies where the government collects revenue, that's taxation, and then policies where the government disperses funds, that's spending. The purpose of taxation, of course, is fundamentally to finance the government's activities. And then the government's activities range from, mostly public goods, military, defense, police, public health, etc. But then what we'll focus on today is the macroeconomic impact of this. Can the government stabilize the economy through tweaking tax rates or tax policies? Can the government help stabilize the economy and employment through various government programs and government spending activities? Right, so the focus here is macro stabilization beyond just the government doing its core jobs of providing law and order and protection, etc. And we are focusing right here on the federal government only, the U.S. national government, and all the numbers we'll look at are for the United States government. The states do have their own taxing and spending policies, and those could also be considered fiscal policy matters, but because there's 50 states and it just adds a lot of complexity. Some states have income taxes, some states don't have income taxes. There's a whole bunch of different mixtures of tax regimes throughout the states, so we're not going to look at the state level right now. We're only going to look at the federal. The federal, of course, is huge in comparison to any of the states, and the federal fiscal program impacts everybody in the country. What we'll focus on today is the data about the tax side, the revenue side of the federal government, and then the spending side. I want us just to have a basic familiarity with these numbers and the main programs. We're not going to get into a whole lot of detail because there's lots and lots and lots of federal programs. The tax side is a little bit easier to understand, at least at a high level, but we want to just have a general sense of the numbers we're talking about and the main elements of the government's finances. But before we get into that data, let's talk about fundamental fiscal principles. Fiscal principle 1 is that all taxes are income taxes. I don't care how a tax is labeled, because only some taxes, you'll notice here in a minute, only some taxes are labeled as income taxes. But all taxes come out of your income, because if the more you pay in taxes, the less money you have to spend, and that money ultimately comes from your income or somebody else's income. Now, how do you earn income? You earn income by producing goods and services. So we might also say that all taxes are production taxes, because the more taxes you pay, the less production you have at your disposal, the less you can consume. And really what we're getting at here is that taxation fundamentally is a transfer of resources from the private citizens to the government. Now, that's not to say anything against taxes. We're going to be non-normative here, but we want to realize that this is what's happening with taxation. There's no such thing as a free lunch. That's a pretty common saying in economics. There's no such thing as a free tax. Taxes reduce people's income. Taxes reduce the amount of production and consumption that people are able to enjoy. Often for good purposes, possibly for financing proper government services, possibly for bad purposes. We'll leave out the value judgments for now. Okay, so let's take a look at federal government revenue. And I've got the data for current fiscal year 2020, recording this here towards the end of April 2020. And we'll highlight the main categories here. Now, the tax side, as I mentioned, is a little easier. There's basically three big sources of federal revenue, and that would be social insurance tax. By the way, I get all of this data from a site called usgovernmentspending.com. Excellent source for all the data on taxes, revenue, debt, deficit for the federal government and for the state governments. Okay, so we have social insurance tax, which you probably are familiar with under the term payroll tax, and that's FICA, which is your Social Security tax, and then your Medicare tax, which comes out of your paycheck. And I'll give you a rundown here in a minute or two about how that works. So that's collecting currently about $1.3 trillion for the federal government, which is 35% of their total revenue. Then we have the income taxes, and this is where we get to that issue that, well, only some of these are labeled income taxes, but they all come out of your income, right? It's obvious with the payroll tax, it comes right out of your paycheck. So that's an income tax too, even though it's not labeled an income tax. It's labeled here as a social insurance tax, but Might as well call it an income tax. So income taxes altogether, the Fed's collected about $2.1 trillion there. And there's two categories of that. One is the personal income tax. Now this is what you file. You have to file your 1040 form by April 15th of every year. This year we got an extension till July 15th. And the bulk of that you'll see is the personal income tax. So people individually have to file, report their income, and then pay. And we'll walk through how this works. It's called a progressive system, where the higher your income goes, the higher rate you pay on additional income you earn. And then corporate income taxes make up a fairly small slice of that, maybe just over about 10%, 264 billion. Corporations do the same thing. They have to file income tax returns and then pay currently, I believe 21% on net income, although there are lots of deductions and carve-outs and exemptions for both businesses and individuals. So we'll take a brief look at that. It's very complex, but we'll just take a brief overview. And then kind of bringing up the rear of federal revenue, we've got some federal ad valorem taxes. Now these would basically be sales taxes that you pay at a national level, right? Most of us are accustomed to paying state sales taxes, and those are usually on a percentage basis. So here in Michigan, we pay 6% on all of our retail purchases. And then on certain goods, in addition to the state sales taxes, we also pay federal sales taxes. Do you know what goods the feds collect sales taxes on? Fuel, so there's a gas tax. That's currently 18.4 cents per gallon. Tobacco, alcohol. Okay, and there's a few others, I think ammunition, a few other miscellaneous things that the federal government collects those kind of taxes on. Fairly small portion of their overall revenue, only 7% currently. And then there's some miscellaneous fees and other sources of revenue, pretty small, just 2%. So the bulk of it is taxes we pay, whether right out of our paycheck, payroll taxes, or through a kind of complex filing system with the Internal Revenue Service, or through higher prices, higher costs for certain things we buy. Sources of federal revenue. Total federal revenue scheduled for 2020 is 3.7 trillion, which is just under 17% of total GDP. And if we look at total tax revenue for the entire country, so every state, locality, and the federal government combined altogether, we're looking at about 7.3 trillion, which is almost 33% of GDP. So if you're looking at other countries where they talk about how the tax collection is a certain percent of GDP, most countries do it only at the national level. So this would be the number you would want to compare, right? If you look at another country, if somebody tells you like Denmark collects 40%, I don't know if that's the actual number, but let's say that Denmark collects 40% of its total GDP in taxes, you would not want to compare the 16.6% because that's just the federal government in the US. You would want to look at the 33% because that's all levels of government. Okay, now let's take a more detailed look at the personal income tax system. As I mentioned, it is a progressive system, which means people with higher incomes pay higher tax rates and pay a larger percentage of their total income in taxes. And this is what our tax structure looks like. We're looking at a chart here of marginal tax rates. And this starts kind of complicated because it's showing us two things. It's showing us the way it looked in 2017, and then the way it was changed in 2018 with a program known as a tax reform legislation known as the Tax Cuts and Jobs Act. So that's where you see this TCJA. And what TCJA did was a fairly modest reduction in tax rates, although it did some other pretty significant tax reforms. One of the big ones was that it did major reduction in the corporate income tax rate. In fact, that was the biggest element of the Tax Cuts and Jobs Act. But it did also push down personal income tax rates. So here's how this works, and we'll get a more thorough understanding of this with the homework assignment for this unit, so I'm not going to spend too much time on it right now. But basically, it says that for this level of income, so here and this I think would be for a single person, for your first roughly 20,000, I think 24,000 of income, you don't pay anything. Okay, so that income's all exempted. Then the income from 24,000 on up, you're going to start paying 10% on that chunk of income. Then once you hit the next threshold, which is somewhere around 45,000 or something, you're going to pay, I believe it's 12%, but only on this chunk of income, on this tranche of income above that threshold. So you pay 10% on this chunk of income from 24 to 44,000. You pay 12% on the next chunk of income up to about 100,000. You pay 22% on the next chunk of income, and then you pay, right, and so on and so on. So, and this is what it used to be. This would have been the 2017 rates, and then blue, and then the purple is what it was changed to in 2018 and what it currently is. Now the rates will stay the same year to year. The income thresholds will be ticked up gradually. They are indexed to inflation. So the idea there is to prevent what's known as bracket creep, because if inflation's happening and these income brackets don't get moved up, you're going to get pushed into a higher and higher tax bracket just because of inflation, just because inflation makes your nominal income go up over time, even though your real purchasing power is not going up. So the IRS releases a schedule of the thresholds where those tax rates hit, and they update that every year. They index it to inflation. Okay, now based on progressivity and based on the fact that you're paying a much higher tax rate on higher income, people with high incomes are paying the bulk of U.S. taxes. Now I have data for this as of 2014. I could probably dig and find more current data, but this structure is pretty constant over time. So if we look at income breakdowns by what are known as quintiles, so this is the bottom 20% of earners, the middle 20%, the second lowest 20%, the second highest 20%, and then the top 20% of earners. So we've got all income earners represented here, and they're, as of 2014, this is what incomes would put you into that range. So if you are under 24,000 in income, you're in the bottom fifth. If you're above 134,000 in income, you're in the top fifth, and so on and so forth. Here's the share of income that those people earned. Now, of course, people with high incomes earn a whopping share of the total income, because there's no upper limit on these incomes, right? You're including pro athletes who are making multi-millions, corporate execs, who are making lots of money. There's some people whose income is into the billions, people with huge investment portfolios, corporate titans, that kind of thing. So these people earn most of the income, 51% of the income, but look what they pay in the terms of the personal income tax. They're paying about 84% of the taxes. So they're paying a disproportionately large share of what they earn in taxes. People in the lower income brackets, in fact, in the bottom 40% here, have a negative share of the personal income tax. Now, how does that work? Well, again, as we'll see in the homework assignment when we take a closer look at this, there are things called refundable tax credits where you can actually get a net refund from the federal government on your taxes. So that means you're not paying any taxes. The government's giving you some money back, so to speak. It's not really giving it back if you didn't pay them. But basically, some people call it a welfare check or a subsidy check from the government, and it's being operated through the tax code. And I'll clue you into a few of the major sources of that in the homework assignment. That would be something called the Earned Income Tax Credit, and then also the Child Tax Credit. Okay. Zoom in here on the top 20% of taxpayers and take a closer look at what they in particular are paying. So we can look at the 80 to 90% income percentile, so 90 to 95, 99, and then above 99. So this would be only the top 1%. And in 2014, you had to be earning $615,000 a year to be at that threshold. Those people earn 17% of all income in the country, but they're paying 46% of all the taxes. So almost by themselves, the top 1% of people are almost paying half of all the personal income tax. And that's only 3 million people. So we have what I would call maybe not just a progressive tax system, but a hyper-progressive tax system, where the more money you earn, the larger and larger and larger your share, your burden of total federal income taxes goes. Okay, so the reason I want you to be familiar with this is because there's a lot of debate about how progressive our tax system should be. And there's a lot of people saying it's not progressive enough. Quote, the rich should pay their fair share. Well, other people would argue that the rich are paying more than their fair share. The rich are paying disproportionately much more in taxes than the lower income earners. Now, what should these numbers be? I don't know. As an economist, I don't know. I don't have my personal opinion about it, which I'm not going to tell you, but this has to be settled through politics. This is not something economics can tell us the answer to. However, economics can give us some ways to think about what the impact might be of higher or lower tax rates, and we'll talk about that here momentarily. Okay, now, the income tax system is highly progressive. That's just the personal income tax system. If we look at all taxes, and so I just want to briefly look at all taxes across the board, state and local taxes, There's property taxes in there. A lot of states have their own income taxes, sales taxes at the state and local level. The tax burden will be a little bit flatter across income levels because lower income people face a disproportionately high burden for especially sales taxes because they spend a proportionally higher share of their income on those kind of goods. When we look at the overall tax bill for all taxes that people pay, well, for the lowest income quintile, for the lowest 20% of people, they're paying about 17% of all their income in taxes still. And the reason why, well, payroll taxes hit everybody, sales taxes, property taxes, federal income taxes, right? These people, remember, are not really paying them. They're getting refunds. They're getting tax credit refunds, but they're still paying all these. So you're still paying taxes. It's not like the poor don't pay taxes. They just don't pay federal income taxes. Nonetheless, the overall system still is progressive. As we go up, let's look at the middle quintile of income. They're now paying 25% of their income in total taxes. And then the higher income levels here, we're looking at the top 10, 5, 1% here. Now they're paying about 30%. You might wonder, why does this top 1%, why is that a little bit lower? That's about like 28, 29%. How do they get away with having a slightly lower overall tax burden than just like we've got like the moderately wealthy here and then the super wealthy here? How come their tax burden's a little bit lower? The reason why is because more of their income for the super rich is passive income. And passive income, like investment income, is usually taxed at a lower rate than the top bracket for active income, earned income. These people up here have a top marginal tax rate of 37%. On their earned income, they're paying 37%, but on their investment income, they're only paying 15% because that's tax that was known as a capital gains rate. So as I mentioned, this gets really complicated. We're not going to get too much into the weeds here. If you're an accounting major, you might be taking classes about this, but for the rest of us, we'll just know the minimal amount and then rely on the experts for the rest. Now let's look at what they're spending the what was it, $3.8 trillion the government is scheduled to collect for 2020. They're spending $4.8 trillion. So right off the bat, we want to notice they're spending quite a bit more than they're collecting. We'll talk about that momentarily. But let's take a quick look at all the categories of federal spending. The major categories are all listed here, and I want to focus on the biggest ones. So the biggest ones we'll see are defense or military spending. That's about $1 trillion. I went ahead and converted that to percentage here. So that's about 21% of the total. Okay. Then healthcare. And for the federal government, healthcare breaks down to Medicaid, which is federal assistance for the poor. It's basically a federal government health insurance program for the poor. And then Medicare, which is a federal government health insurance system for the old. Okay, so the federal government takes care of the bulk of healthcare costs for the very poor and the old. And that is 27%. That is the largest item in federal spending. So a small slice of this is public health spending, research and development for drugs and treatments, etc. But the vast majority of this is Medicare, Medicaid. Right, so the federal government takes care of the health insurance costs for two large groups of people, and that is the largest item in federal spending and the fastest growing item in federal spending by far, 1.3 trillion. Okay, so that's number size-wise, that would be number one. Okay, number two size-wise would be pensions. Now, what federal government-run pension program, retirement income program, mostly for old people, although part of this is for disabled people, part of it's for survivors, so people who died. That would be Social Security. Okay, Social Security, and that's currently 25%, so that would be number two size-wise. Military or defense up here would be number three size-wise. So there you go, the big three in terms of federal spending. And you'll hear me reference this, and I think there's some quiz questions, test questions that ask about the big three when it comes to federal spending. Military, government health care programs, which remember, so that's Medicare for the old, Medicaid for the poor, and then Social Security, retirement income. I think about 90% of that is the retirement income, the checks your grandparents get every month. And then about 10% is disability programs and other adjuncts of the Social Security system. And altogether, let's see, what does this add up to? That's about 75%. That's about 3/4 of total federal government is just those three programs. And then everything else is a mixture of much smaller things and things we often associate with the government, right? Welfare. This is direct aid for the poor. Some of it's cash aid, a lot of it's food stamps, a lot of it's housing subsidies. Well, that's only 8%. That's only 0.4 trillion. Education subsidies, There's various forms of that. Some go to K-12, some go to college students, grants, etc. That's only 0.2 trillion. That's only 4%. Okay. Protection, this would be things like federal police, the FBI, that kind of stuff. That's only 2%. Transportation spending, federal aid for building roads, bridges, airports, etc. That's only another 2%. General government, this would be like the administrative burden of the government, managing government properties, that kind of stuff. That's only 1%. Other spending, everything else would be thrown in there, national parks and every other thing the government does. That's only 2% of their spending. So all the stuff that we might associate with, like, these are the core functions of the government, maybe might throw defense in there too, but other than the military, that's a very small percentage of government spending. Here's an interesting one, pun intended, interest on the national debt. Now, you might say, well, it's only 8%, but that is growing rapidly. If we went back even like 5 years ago, this would have been only like 3%. So this is growing very rapidly, and for reasons that we'll discuss here momentarily. It's because the government debt is growing very rapidly. The government is accumulating debt at a massive pace, and even though interest rates are at historic lows, if you are accumulating a lot of debt, even if the interest cost is low, that cost burden will rise rapidly. So this is possibly the most alarming category here if you're concerned about government spending and government debt, because it is the fastest growing category percentage-wise. Okay, now let's talk about this issue which I just raised. How can the government be spending 4.8 trillion, unless I crossed out, I had the data for last year up there, when its revenue is only 3.7 trillion? Okay. Now notice that spending and revenue both grew about the same amount, but it's been consistently about $1 trillion in the hole. Well, that's what we call deficit spending. The deficit is the amount by which spending exceeds revenue, and the way the government copes with that is the same way you would. If you spend more than you earn, that means you have to be one of two things. You have to be either borrowing money or selling off stuff you own. Now, the government is not selling off stuff it owns, at least not nearly enough to pay for the shortfall, so that means it has to be borrowing money. Right? So let's do some terminology first. What is the deficit? It's the annual difference between spending and revenue, and that's roughly speaking the amount the government has to borrow in a given year, although in actuality the government usually borrows more than this because the budget is not quite an accurate representation of what the government's actually doing. But roughly speaking, that's the amount the government's going to have to borrow every year. The debt then would be the total accumulated borrowing over time. And for the U.S. government, that's been since like 1835. In 1835, under President Andrew Jackson, the U.S. government paid off its debt completely. It had a government debt of zero. And of course, it didn't have a government deficit either. It had a government surplus, and it used the surplus to pay off the debt. But since then, the government started running deficits again, very small at first, although they ballooned in certain historical periods of national emergency. But we've been accumulating debt in the United States for 185 years or so, and every year, right now we're adding about $1 trillion a year, maybe likely much more than $1 trillion this year. So the debt's going up and up and up, and we'll take a look at these numbers here. Here's the deficit for the past roughly 12 years, and I just want to point out a couple things here. In 2007, we had a deficit that was only about $250 billion. And actually, I remember at the time some people were very alarmed about the growth of deficits from 2007 to 2008, where it almost doubled. It was like, I think like 476 billion or something. So we had an almost doubling of the deficit here from 07 to 08, and people were so alarmed. Oh my goodness, President Bush is running up the national debt and the deficit. But then look what happened in 2009. 10, 11, and 12. We exceeded $1 trillion deficits for the first time in our history. Now, as we'll learn about in the next couple lectures with Keynesian fiscal policy, well, there was at least some rationale for this. I'm not necessarily saying I agree with it, but there was at least some rationale in terms of increased government spending during times of recession, because we had the recession here in 2008, 2009. So this is a recessionary period, and there's various reasons why the government spending would grow. Okay, and then it actually starts to come back down. President Obama is now in office, and the deficits come back down, and we got back down to 2008 levels under 500 billion. So we had kind of gotten back to our starting point here, and the recession is over, the economy is growing again. Now, interestingly, and this is what I want you to notice, the deficit has started rising steeply, and we're actually on pace for this to go maybe double again. We're possibly on pace here in 2020 for a $2 trillion deficit, which is just absolutely mind-boggling. But keep this in mind when we talk about fiscal stimulus policy and Keynesian fiscal policy, because the argument for rising deficits is you use them to counteract a recession. Now, were we in recession in 2016, 17, 18, 19? No. Now, right here in early 2020, April 2020, are we in recession? Yes, we're definitely going into a very large recession, right? But we had the upward trend in the deficits well before, and we returned to the $1 trillion deficit level well before the next recession started. All right, so massive increases in spending, not matched by increases in revenue, massive increase in deficit, and therefore accumulating massive increases in government debt. Here's just the big picture of the U.S. government debt. We're roughly, this is April 27th, current data, roughly at 25 trillion in total government debt. Of that, 17.2 trillion is held by the public. And by the public here, we mean some of it could be like Joe Schmo citizen, but most of that is financial institutions, banks, companies, businesses, and that it would include foreign companies. So banks in other countries or businesses in other countries will buy U.S. government bonds and hold some of this debt. The amount that's not held by the public is held within the government itself, and that's going on 7 or 8 trillion. And the biggest holder of that would be the Federal Reserve, the U.S. government's bank. All right, and currently, well, this is actually going to be a lot larger. The latest data I could find was for quarter 4 2019, and it's about 2.6 trillion. I wouldn't be surprised right now, as of April 27, 2020, I wouldn't be surprised if this is already $1 trillion higher, because what the Fed's been doing recently to react to this new recession that we're in. All right. Here's a historical chart on U.S. government debt held by the public. This is going back to about 1970, and I just want us to look at a couple trends here. We had a pretty small and steady growth in this up until the late 1990s. We had an actual reduction here in the late 1990s under President Bill Clinton. The government ran 4 years worth of surpluses, and the debt went down just a little bit. Not a lot, but it went down. It stopped growing. That was pretty remarkable. It starts growing again pretty modestly under President George W. Bush here in the early 2000s. But then here's our inflection point. Recession of 2008, 2009. That's this period right in here. And you can see that the debt started growing just at incredible pace again. And even right here, just in the last, just recently, in this year alone, we've seen a significant uptick. So we just have growing government debt. Government debt held by the Federal Reserve. Likewise, you can see that was pretty modest on a pretty steady and slow growth pace. As late as 2007, that was only $800 billion. That would be $0.8 trillion. And then that started to balloon when the Fed started taking dramatic actions to expand the money supply after the recession of 2009. And again, we're currently sitting here at 2.6 trillion, but I wouldn't be surprised if this is just going through the roof again, because the Fed is taking similar actions because of the recession we're in right now. Good way to think about the level of government debt is to divide it by GDP, because that kind of scales it to the economy. So you can see here we're looking at the percent, the debt to GDP ratio, the percent of GDP represented by the federal debt. And now we're going back to 1900. Notice it's very low. It's actually declining slightly in the early 1900s. It balloons right here. This would be World War I, when the government needs to borrow a lot of money to finance a massive military buildup. Then it goes down again. It goes up here in peacetime. This is the Great Depression in the 1930s, when the government starts doing massive deficit spending. And then it goes up even more to the highest level we've seen so far in World War II, when the government does an even bigger mobilization than it did in World War I. Then that goes down. Now the actual debt doesn't go down, but the economy grows faster than the debt here, which makes the debt to GDP ratio decline. Bottoms out about 1980. Deficits start growing again faster than the economy in the 80s. Here's Bill Clinton pushing that, running government surplus, pushing this down a little bit, right? And then we turned, and we're now growing, and we're approaching World War II levels of debt to GDP ratio. Okay, now given this overview of government spending and debt levels, that brings me to fundamental fiscal principle 2. All government spending must be paid for by some form of taxation. In other words, running excess government spending through deficits, through the issuance of debt, through borrowing, is not free. It ultimately has to be paid for through taxation. So what are the options the government has available to pay for its spending? Well, there are three. First one is direct taxation, and this is what I call the open and honest method. The government's going to spend, let's say, $4 trillion. It's going to tax us this year $4 trillion. It's going to be upfront about this is how much of the economy we're taking, how much of production we're taking for government use. You may not like it, but this is the reality of what we're spending, and we're going to take it right now. Now, we do about 3/4 of our government spending through this, and then 1/4 or more through the next method, which is deficit spending, borrowing. Okay. Now, how is borrowing paid for? How is debt paid for? Debt, for you, if you take on debt, you have to pay that out of your future income, right? If the government takes on debt, it's no different. It has to pay that out of its future income, which means it either has to raise taxes in the future to pay down the debt it's accumulated, or reduce spending in the future, right? And later on, we'll examine how likely either of those scenarios is. Right, so deficits imply higher future taxes. That's the key. That's kind of a key fact that I want us to bear in mind right now. And then finally, we have something the government can do that no other entity in the economy can do, which is printing money to retire its debt. And this is known as debt monetization. Last resort for over-indebted governments who find that they've kind of exhausted the limits of taxing their people. And then they will also find that they will exhaust the limits of borrowing, because eventually people with money to lend, people who are interested in buying those bonds, investors and savers, might say, you've borrowed too much and we're not going to lend you any more money. And that's a sudden stop to borrowing to credit, which will often happen. And it can happen to an individual person, it can happen to a government. And if that happens, a government that can print its own money, which would of course include the United States because we have the Federal Reserve System, will start printing money to retire its bonds or buy back its bonds, and that is called monetization. Here's what we want to notice about that. Excessive money printing implies inflation. And we'll think about this with respect to our old friend, the equation of exchange, most important tool in macro, right? What happens if the government prints too much money through its central bank to retire its debt or to help it meet its debt burden? Well, too much money creation over here is going to be matched by increases in the price level over here. So inflation happens when government central banks start to engage in money printing because they spent too much, and they're now in phase 3 of government finance methods. So that's something I want to keep in mind. We'll talk a little bit more about that later on. The inflation tax, remember, inflation is a tax because it transfers resources from the people to the government, from late to early recipients, from creditors to debtors. Well, who's the first recipient of new money? It's always the government itself, right? Who is the debtor? Who is the largest debtor entity in the economy right now? That would be the U.S. government. And this is a site I like to check out regularly. It's called usdebtclock.org, and you can see it's a running clock that shows the national debt, federal spending, the federal deficit, federal revenue, and then it breaks it down on many relevant categories. So a very useful site if you're interested in this stuff. And we can look at the growth in this. It's amazing to see the fiscal situation of the U.S. government kind of unfolding before our eyes. You can see the budget items here and the interest on the debt, everything. So there's tons of data here, but the main thing we're interested in is this just absolutely ballooning national debt. And the question that this implies is, how is the government going to pay for this? Well, you got options 1, 2, and 3. Okay, so do we have a government debt problem? This is something we'll look at, and we'll watch a video about this from former Comptroller General, which is the top U.S. government accountant, David Walker, who says, yes, we do. And I'm suggesting to you that nobody knows the government debt problem better than the former top accountant for the U.S. government. On the other hand, we have politicians who often take the viewpoint that we don't need to worry about deficits. For example, former Vice President Dick Cheney was directly quoted as saying this, and this was back in the George W. Bush years when the deficit had started growing again, although it wasn't even near the levels we're at right now. Cheney says, we don't need to worry about deficits. Why? Because it's a problem for future generations, and frankly, he's an old man. He'll be probably dead and gone by the time the debt problem comes home to roost. David Walker maybe is a little bit more concerned about future generations and how they're going to have to cope with this government debt problem. And we'll watch a very informative video by David Walker to walk us to explain how that debt problem could possibly unfold.